NextEra Energy is currently trading at $84.41. That's up $1.16, or about 1.39% on the day. Now, for a company that many people file away in their individual brokerage account as a safe utility, that 1.39% move is actually quite aggressive. It's showing more life, more volatility than you'd expect from a simple power company. And that jump gets right to the heart of the central misunderstanding of this stock, a stock that has become one of the most important and conflicted names in the entire market. The general belief, the one that built this company into a $170 billion plus giant, is that NextEra is the perfect hybrid. The expectation is simple. You get the rock-solid, predictable, regulated cash flows from Florida Power and Light, FPL, which is America's largest utility, and you combine that with the massive, high-octane growth from NextEra Energy Resources, NEER, the world's largest generator of wind and solar. It's supposed to be safety plus growth. It's the stock Fidelity Wealth Management teams and automated systems like Schwab Intelligent Portfolios have loved for years, because it was, for a long time, a bond alternative that actually grew. But the reality, and what this $84.41 price tag truly reflects, is that NextEra isn't just a utility anymore, and it hasn't been for a while. It's a high-growth, capital-intensive industrial developer chained to a utility. And that developer side, the NEER segment, is completely and totally beholden to one thing: the cost of capital. In the last couple of years, this stock has stopped trading like a utility and started trading like a direct proxy for the 10-year Treasury yield. Today's 1.39% jump isn't some sudden massive surge in demand for green power in the last few hours. It's the market breathing a collective sigh of relief that interest rates might be stabilizing or even pulling back. The entire investment thesis here has become far more complex than just green energy is the future. The future is guaranteed. The profitability of that future is what's in question, and that profitability is set by the bond market, not by climate policy. Let's be perfectly clear about what moves this stock day to day. When you build billions upon billions of dollars worth of solar farms and wind turbines, you don't pay for it with cash you have in the bank, you finance it. You issue massive amounts of debt. The entire profitability of a 20-year power purchase agreement is decided the moment you lock in your financing rate. For the last decade, with interest rates pinned to the floor, this was an unstoppable model. NEER could build, finance cheaply, lock in a profitable rate, and repeat. It was a machine. But now, the game is completely different. Every single tick up in the 10-year Treasury yield crushes the future profit margin assumption for NEER's entire project backlog. Conversely, a day like today, where yields might be softening, provides an immediate and powerful tailwind. This is why NE's stock chart for the past 2 years looks like a perfect inverse chart of the 10-year yield. It's not trading with its old-school utility peers, it's trading like a long-duration, non-dividend-paying tech stock. It has more in common with how Apple stock or Tesla stock reacts to a Fed statement than it does with Duke Energy. This $84.41 level is also technically significant. The stock has been on a very strong run from its 52-week lows, which were down around $62. It's now fighting to get back near its 52-week high, which is just a bit north of here at $86.74. We're seeing it try to establish 84 as a new support level before its earnings report, which is just around the corner. The trading volume today is solid, but it's not spectacular, suggesting this isn't a panic-driven move or a short squeeze. It feels more like institutional repositioning. You're not seeing a massive surge of activity on on the Robinhood app for this. This is the kind of methodical move driven by large Fidelity mutual funds or SoFi robo-advisor allocations, making a calculated bet that the worst of the rate hikes are behind us. The big players, the ones who use professional platforms like Interactive Brokers for their complex orders and to get the best Interactive Brokers fees, are likely the ones soaking up shares at this level, believing the macro environment is about to turn in NE's favor. This optimism is also being fueled by some very important company-specific news. The recent rate settlement for FPL in Florida was seen as very constructive by the market. It provides clarity, stability, and secures their earnings base. That's the bedrock, the FPL cash flow, that funds the growth of NEER. The board also just declared its regular quarterly dividend, that 0.5665 per share, payable in December. This is a critical signal of stability. In a market that has been starved for good news, a no bad news update from the regulated side of the business is treated as very good news. It calms the nerves of long-term investors who might be holding this stock in their Fidelity IRAs and were getting seriously worried about the uncharacteristic volatility. They signed up for a utility and they felt like they were holding Nvidia stock on a bad day. This gets to the core tension for anyone doing self-investing and looking at this name. Are you buying NextEra today for its 2.7% dividend yield, or are you buying it for its long-term 8 to 10% earnings growth target? Because in this environment, those two goals are in direct conflict. A traditional utility investor wants low volatility and a safe dividend. A growth investor wants upside and is willing to accept volatility. NE is trying to be both, and as a result, it has recently been giving investors the worst of both worlds. The high volatility of a tech stock, but without the explosive AI-driven upside. Today's 1.39 pop is a risk-on move. The market is deciding that just maybe you can have both again. This is the expectation, the hope that is being priced in at $84. This complexity is why online investment platforms are so popular, but also why investment help is so critical. You can buy NE with one click on the SoFi investing platform or the Fidelity mobile app, but the why behind that click is what matters. The Robinhood stock trading platform made fractional shares accessible to everyone, but it didn't prepare investors for a utility stock that can drop 10% in a week because of a bad inflation report. This isn't a buy and forget stock for your intelligent portfolio right now. It's an active investment that requires a strong opinion on macroeconomics. The research tools on the Fidelity trading platform or the Interactive Brokers platform are essential for tracking the institutional flow and debt markets that are really driving this stock, not just the headlines about green power. Many Fidelity ETFs and SoFi ETFs are heavily weighted with NE, and their performance has been directly tied to this rate sensitivity. So, to put a finer point on it for anyone new to the story, what is this company? It's really two distinct businesses. First, you have Florida Power and Light, FPL. This is the classic, boring in a good way, regulated utility. It serves over 12 million people in Florida, a state with strong, consistent population growth. FPL invests billions in its grid, making it stronger, more efficient, and cleaner. Then it goes to the Florida Public Service Commission, shows its costs, and gets to charge rates that guarantee a set return on its equity. This is the cash flow engine. It's predictable, reliable, and provides the stable dividend base that everyone associates with the company. It's the foundation. Then you have NextEra Energy Resources, NEER. This is the sexy part of the story, the part that gets all the attention. NEER is the world's largest generator of renewable energy from wind and solar. It's a developer, not a regulated utility. It builds massive energy projects, think solar farms the size of cities, and then sells the power to other utilities or to corporations like Google or Meta on very long-term contracts, often 15, 20, or 25 years. This segment is what provided the high growth, the 10% annual earnings growth, that made NE outperform the S&P 500 for a decade. But developer is just a nice word for a capital-intensive construction business that relies on heavy financing. The spectacular success of this model in the past was built on a foundation of declining interest rates. In the past 2 years, that foundation cracked. This brings us to the future outlook and back to that core conflict between expectation and reality. What is the bull case from $84.41? What does the market expect will happen to justify this price and send it higher? It's simple. The Fed signals it's done or even hints it cuts, and the 10-year yield falls convincingly. If borrowing costs drop, NEER's massive project backlog, which is tens of gigawatts deep, suddenly becomes more profitable. The investment thesis that worked for 10 years comes roaring back. Add to this the massive structural tailwinds from the Inflation Reduction Act, which provides huge tax credits for building exactly what NEER builds, and the company is in the perfect